to listen to our presentation today over the lunch hour. I would like to remind everyone that this series of conference calls is sponsored by BMO Harris Bank. BMO Harris Bank has dedicated bankers in the local market who understand your business, industry, and market, and they offer solutions tailored to your unique needs. BMO has deep roots in the community with a long history of supporting Forward Janesville and other local nonprofit organizations. I'd like to personally thank BMO Harris for sponsoring these conference calls. Today we have an interesting topic we're calling What's Driving Janesville's Red-Hot Real Estate Market? Unless you're asleep at the wheel under a rock, you know that home prices are escalating, and the stories about bidding wars for available homes are the kinds of things you hear about anywhere when you're out and about. And we have four distinguished panelists who are going to help us dissect this housing market in 60 minutes or less. We have David Hiller, who's the CEO of Amwood Homes, a home builder here locally. We have Ryan Walsh, head of U.S. mortgage sales for BMO Harris Bank. We have Paul Schieldt from Coldwell Banker, the Realty Group, and R.K. Smith Realty. And we have Gale Price, the Economic Development Director for the City of Janesville. So I'd like to start with you, David. You have a perspective, of course, from the new single-family home building perspective, and we're anxious to hear your take on what's going on with this red-hot real estate market. David?
Hey, thanks, John. Also appreciate the opportunity to be on the call today. My perspective is a little bit unique. We operate two different businesses. We operate a company called Advantage Homes. We build new homes in Rock County as well as some land development. We also have Amwood Homes that builds components. So we're part of the supply chain, and we distribute those components in 4 different states. So my comments today are kind of a blended perspective, both as a single-family home builder as well as a manufacturer, part of the supply chain. I think we've all heard of some of the supply chain challenges, and I'll try and address some of that today. As you stated, we're dealing with a variety of forces and interesting things going on, like very low interest rates, lumber costs are, you could call them all-time high, very low home inventories, rising prices. You talked about number of offers you get on a house. You kind of look at all of that together, and I think today our goal is to try and make some sense of what's going on, right? And so I wanted to start off with a couple of data points. And so the Wisconsin Builders Association publishes new housing permits. And if you just look at first quarter 2020 versus first quarter 2021, Wisconsin housing permits were up 35% for the state of Wisconsin. Dane County, interestingly enough, was down 11% for new housing permits. Sheboygan County was down 4.4%. Rock County up 48%, right? So that tells you something. Then you kind of go out and look at the media a little bit, and they've got a bunch of different rankings out there, and just I thought I'd share a couple of very interesting ones. So Realtor.com published their hottest housing markets in the U.S., their publication date of May 13th. They rank Rock County number 4, ahead of places like Madison, Wisconsin, Colorado Springs, Colorado, Portland, Maine, and Worcester, Massachusetts. So very interesting that we're ahead of places like Madison and Colorado Springs. USA Today last week published some data on the top 10 markets in terms of home price increases since 2017. Boise, Idaho is number 1 on that list. Phoenix, Mesa, Scottsdale, number 10. We came in at number 6. Janesville, Beloit is number 6 with a 55% increase in medium home prices. So not a strong market, I would say. I'd say it's one of the strongest in the country. And really, in general, probably decent news for the community. Very positive sign from an economic growth perspective, right? It's important that we understand some of the drivers of the market, and so I want to just touch on a few different components of drivers. And first is demand. Homes, quite frankly, today are more important than they were probably 18 months ago, and that is driving some demand, right? People have spent a lot more time in their houses, and they are definitely more important than they used to be, and we're starting to see home designs actually changing, right? So workspace is now much more important than maybe a spare bedroom, right? So homes are more important. That's driving some of the demand. I'm sure Ryan will talk about this, but interest rates are unbelievably low, right? So last 12 months, basically, we've been kind of hovering at this recent historical all-time low. So that's a massive factor in continuing this demand. Other factors, we're seeing, people are on the move, right? So you hear a lot about people being on the move. You see a lot more interest from millennials buying houses, right? And then you have this whole notion of, oh, by the way, I really don't need to go to an office anymore, right, for my work. So there's a number of positions out there where offices are not required. I'll give you a couple recent examples of people being on the move. It's important that you actually talk to people that are moving and wanting to move to Rock County, wanting to move to Janesville. I talked to two couples last month. One couple was in their 60s. They were trying to leave a Chicago suburb, which they weren't real happy with, and they just wanted to move to Janesville. They're in their 60s. And then within an hour, I talked to another couple in their mid-20s, and the wife in the couple works up in Madison at a chiropractic clinic, and then the husband works for a tech firm out in California, and the tech has basically said you can work wherever you want. And so they are finding that, hey, the quality of life in Janesville is great. The cost compared to California is a huge difference, and what a great place to live, right? And so that ability to not have to be in an office, not have to be in a physical location, is probably driving people towards our community. But there's one big thing that, from an economic perspective, that I want to touch on from a demand standpoint. And you have to go back and look at some history. So a gentleman by the name of Robert Dietz, he's a chief economist for the National Association of Home Builders. He will tell you in one of his articles, that 2010 to 2020, so the last decade, was definitely underbuilt. So the number of housing starts from 2010 to 2020 was 50% of the prior 3 decades. So those prior 3 decades were the 2000s, the 90s, and the 80s, okay? So think about that. You had very consistent home starts, 2000s, 90s, 80s, and then you get to the last decade, and we only build about 50% of the houses we normally build. And oh, by the way, the 60s and 70s, way back then, even more building going on than the 80s and 90s. And so you had this one decade that's an outlier, which was our last decade, where, frankly, not a lot of homes were built, right? So it's right after the Great Recession, right? You also had a limited number of people going into trades in that decade, and then you had a lot of very limited lot development, right? You need lots to build houses, right? So that underbuilding, we believe, is a pretty big factor in what we're seeing today, okay? Pricing, so let's talk about home prices. So there's, I think John mentioned that at the start. Lumber, okay? Lumber is, over 3x what it was a year ago. So 3 times higher than what it was a year ago. The Wall Street Journal had a great article on May 17th, talked about, our lumber mill is going to expand capacity, right, so that we can bring the price back down. Not a lot of interest to do that right now. Housing is a very cyclical business. What they're investing in is probably more automation and efficiencies, and really not going to do a massive capacity expansion. So lumber is going to remain high, although, and I'll talk about this a little bit more later, but lumber will eventually stabilize, right? We're starting to see it come down a little bit right now, and we're expecting that to stabilize. But more important than raw materials, so raw materials will, they're going to go up and down, they're going to stabilize. But one thing that we believe is a permanent shift is wages. Here's the deal. If anyone thinks that anyone's going to ever go to work at McDonald's again for $8 an hour, it's never going to happen, right? So there's been a permanent shift in wages, right? And that is driving the price of almost everything up, okay? So, for example, you take a look at a house, you have windows in a house. Our window costs have went up since March 2020, 18%. Garage doors, 20%. So 20% up increase on a garage door. We never see those prices of garage doors coming down, right? And a lot of that is labor, right? Labor driven. And so prices are definitely increasing. We're seeing, we're now able, in Janesville, we're able to build spec homes above $500,000. Not a lot of them, but that used to be unheard of in this market, right? You wouldn't build a spec home for over $500,000. We can do that. And frankly, if we had the capacity, we would build more of them because we have people interested in them, interestingly enough. Moving on to supply chain. So just a couple comments on the supply chain. Take a step back. go back to April, May last year, we shut the economy off, right? So it was basically we shut it off, and then we restarted it, especially in the housing industry. We restarted the economy, and then, oh, by the way, we had the normal demand coupled with a lot of additional demand, right? And so we had a restart coupled with an extreme high demand level, and supply chains are designed to be optimized. They're not designed to be robust. We saw that last spring when we were struggling with personal protective equipment, all that kind of stuff. Supply chains are designed to be optimized, right? Low cost, not designed to weather extreme demand fluctuations, right? And so that has caused a lot of lead time extensions on a lot of housing components and just general disruption in the supply chain, which makes it a little bit more challenging than it used to be. But we've been trying to be as agile as possible in terms of finding alternatives and that kind of stuff. But all of that supply chain disruption ultimately increases costs as well. So just some conclusions that we're seeing is that there are multiple factors, interest rates being one of the big ones, that is going to fuel demand for new housing in the short to midterm. We believe it's going to stay strong. Everything that you read, everything that you see, you look at our order patterns, we believe it's going to stay strong in the short to midterm. People are on the move, right? So importance of the home has changed, and people are moving. I can tell you just locally, we're getting out of town buyers. We're seeing a lot of that, right? So that's not a bad thing. That's a good thing. But that's one of the reasons why the market's hotter than it has been. Supply chain issues we believe are going to level out. It's just going to take some time, coming out of that shut off and then restart. But we believe that lumber prices are going to stabilize. Futures are starting to trend downward. Actually, lumber dropped a little bit the last couple of weeks, so we're starting to see lumber kind of come down a little bit. So we believe that's going to stabilize. And then remember that a small uptick in interest rates will definitely cool things off a little bit, not in a bad way, but it could throttle it. So even though you hear that interest rates are going to stay low, and Ryan may comment on that a little bit, but any uptick in interest rates will definitely slow things down a little bit from a new housing perspective. Prices are going to be higher. Wages are a big component of that. I would be careful. There's a lot of notion around, hey, maybe we should build a house later because later will be less expensive. Probably not, right? So if interest rates go up a little bit, that's a component. And again, back to wages, we don't see wages coming back down. So pricing is what it is. But keep in mind that in our community, we have, a ton of value in terms of what you get for your dollar in Janesville. And also you couple that with quality of life, cost of living here. And that's why I think, that's another big component of why we're seeing what we're seeing in Janesville. So, John, I'll turn it back over to you.
Thank you, David. That was excellent. Very thoughtful. And I can't wait to combine that with the other presentations. And next we're going to go to Ryan Walsh. Ryan, interest rates and mortgage financing are hugely important to this industry, and I'm guessing as head of U.S. mortgage sales, you know this material inside and out, so we're anxious to hear from you next. Ryan?
Yeah, thanks, John. And David, very well said and very insightful. I share those same comments. I took a lot away, and I had some overlap, and I won't layer on to some of the comments around pricing and the influence of pricing. I think it's well documented. I think David just did a fantastic job articulating that. So I'll focus more of my conversation around where interest rates are, what we're seeing from a macro perspective on trends, what BMO is really projecting as we enter the second half of the year and even into next year, and also just talk a little bit about some of the downstream impact we're having from vendors, vendor management, and some of the things that we just take for granted as part of the mortgage process, but are definitely having some, again, downstream impact on the consumer itself and really the turn time. So what I'll do is I'm going to start kind of big picture. Mortgages are typically this time of year a 70-30 split. 70% of our portfolio and our production is purchases, and then 30% we see, and this is really industry standard. So again, speaking macro level and kind of industry, 30% would be refis. What's very interesting is across the industry, we're seeing about an inverse, a 70% refi still today, even into the summer purchase season, and 30% purchases. A lot of that has to do with what David alluded to, which is just this lack of inventory, or at least affordable inventory is what we're calling it here. The affordable inventory is really a matrix that we look at. Is can a buyer afford the home they're going after, they're looking at? The answer is not really. And we look at that from a perspective of credit policy. Can they put the 20% down, or the 5% down, or the 1% down, depending on the assistance programs they may use? And that's a huge issue to the mortgage industry. Is borrowers are just getting outpriced, which means they're forcing them to rent, and they're going to stay renters, or they're going to stay in the home that they are, which then limits the inventory that's on the market. So there's just this whole this whole circular effect that's happening due to price. So we're seeing that. We're seeing that in productivity levels across the board. We certainly like to see a huge influx of business this time of year, especially with rates where they are, hovering below 3s for many products, or just right around 3% for many products. When you look at the APR, and that usually is, as rates stay low, it has a parallel relationship with consumer confidence or lack thereof. And that's not necessarily the case today. So if you look at Wall Street Journal and many publications, consumer confidence in the economy is actually pretty high, which you would usually see a rise in interest rates, which we're not seeing, and we don't anticipate to see a huge increase this year, possibly in F22. So rates, if they do remain low, and pricing, stays where they are in homes on new inventory and existing inventory, we're expecting to see a lot of refinancing, a lot of cash out refinancing, which has been a huge business for us this year. A lot of home equity lines of credits being taken out to do home improvements, take vacations, pay for colleges, whatever it may be. People are recognizing that with rates so low in the home equity line of credit, that's becoming a very popular product, or cash out. So that's from an overall perspective, both industry and BMO. That's certainly some trends, and also just some things we're seeing. So more importantly for the substance of this call, I'm sure you guys are wanting to know what's like contributing to this, and what can we expect. So one of the things that I would layer on to David's comments is this urban migration. We are seeing a huge shift on the types of loans we're originating. We're going from condos, doing a lot of condos, doing a lot across our entire U.S. footprint, to now doing a lot of single-family home purchases or single-family home refis. It is a big shift. You've seen a lot of these millennials, but also other generations really, clamoring for a single-family home, both because of pandemic, but also it's just this desire to have a yard, desire to have space, not be next to your neighbor. We do many surveys, and it's all the things that many of us take for granted around having a yard that these urbanites are now wanting, and it's not as appealing to be in maybe downtown Chicago as it once was. So that's a big factor. One that has not been brought up today that we certainly are taking into consideration with our credit policy, and I think it's an interesting conversation that I'd be happy to have a little more discussion on a future call, which is the crypto influence, how that's influencing millennial wealth, and how that's influencing wealth overall. We're seeing this kind of day trading mentality amongst young millennials that are now becoming millionaires overnight. And they're now wanting to buy homes, buy certain goods and services, either through cryptocurrency or just through the wealth they've generated, which is problematic from a mortgage perspective, because we do operate on some pretty heavily regulated guidelines that are not as agile as maybe some other industries, and I'm sure some of you may be laughing right now. So we do have to stick to our credit policies on how we look at that, and that's something that I think everybody's scrambling, including probably the government agencies, Fannie, Freddie, FHA. Everybody's scrambling to say, okay, how do we approach crypto? How do we approach this new generation of wealth that's looking to use some of their market gains to now buy homes, use even crypto to pay for the down payment? What can we do to include that as part of policy, because I think we're missing a huge subgroup of buyers, and also as we start to gain inventory, as prices go up, and we start to build more homes, and that would be a huge miss if we don't capture that audience that's looking to buy homes. So that's a big one, definitely one that we could speak hours on. Then there's also the transfer of wealth that we're seeing as a big factors of these refinancing. We're seeing a lot of gifting of money to down payments. So that's a big factor in some of our mortgage originations of how young buyers and also buyers as a whole are buying these homes. Is they're getting a lot of gift funds, but they're also having transfer of wealth. So that's something that's playing a factor into why every mortgage company you probably call is on pipeline highs right now and have crazy turn times, 90, 120-day turn times just to do a refinance. I'm proud to say we're way less than that, but industry standards are about 75 days for a refinance right now, and purchases are about 30 to 45 days. So I'd kind of bring this home in somewhat of a long-winded conclusion, which is there's a lot of downstream impact from what's going on, both because of COVID. We have really started to remove some of our COVID overlays or COVID readiness plans, meaning we're getting back to pre-COVID credit policy, which is also helping us as we look to attract more borrowers and also just be able to approve more borrowers, which is one of our biggest policies is we want to be a very inclusive bank and also lend to as many people as possible. As those get lifted, it's putting a huge pressure on the entire mortgage ecosystem, one of which is an unintended consequence is appraisals. I don't know if anybody's gone through a refinance or a purchase recently, but appraisals have been the number one headache in the entire industry across the entire country. It's something that keeps me up at night. We have a shortage of appraisers, and then also, as these appraisers are starting to get trained and these appraisal management companies are hiring on new appraisers, just the errors that we're seeing, which of course we have to fix before a file closes, it's causing delays, it's causing errors, and quite frankly, it's causing misclosings. So what's, a process that once took 5 days to return an appraisal, maybe less, is now taking 35 days. And it's a huge issue in the entire process, and one of which I think is important to note, just for this group, as you guys, kind of understand where the mortgage market is and the industry is. Appraisals are probably the number one risk to the momentum that we're seeing in the industry. If we can't solve for this across the entire network of lenders, we have a much bigger issue, because then it's just going to delay a lot of home buyers and refinances. Overall, I am very bullish on where the mortgage market is, both at BMO, but both macro and the industry. I mean, refinances are all-time high. Rates will stay low, is our anticipation. We will continue, as an industry and as a bank, to review credit policy to make sure that we're lending to every qualified borrower. And I do think that, as rates do rise, it will definitely free up some supply, but I certainly think there's a strong demand, pent-up demand, and will be for some time. So, John, with that, back to you.
Thank you, Ryan. That was excellent. And, boy, you echoed a lot of things that just come up in conversations with appraisals, of course. People expecting that they're going to get an appraisal that will support an offer that is just unreasonable. And the whole refi market, oh, my gosh, no wonder people have extra cash for other things. They're getting refis under 2% or so. It's just a remarkable market. And next we have Paul Schieldt, a former Janesville board member, Coldwell banker of the Realty Group, R.K. Smith. Paul, you are on the line, right, Paul?
I am here.
All right. Paul brings a unique perspective, because he's not only on the brokerage and sales side of homes. He also, with R.K. Smith, represents a company that manages a whole lot of rental units in the community. So, Paul, I'm anxious to hear your take on this red-hot real estate market. Paul?
Yes, thank you, and nice job, Ryan and Dave. I'm going to overlap here some too, obviously, because we're kind of all in the same field, but welcome to the Wild West of real estate. I've been practicing for 25 years, and I'm not sure if I've ever seen anything like this. Probably the one of the best times ever to sell and probably the toughest time to buy I've ever seen. I did a little search this morning looking at active homes in Janesville and Rock County. Right now there's 122 active single-family homes with an average list price of $311 in Rock County. Highest being $1.5 million, lowest being $51,000. Now, guess the number of homes of those are available in Janesville. Only 40. Average list price is $295, low being $110, and the high being $699. Oh, oops, we're down to 39 homes now available in Janesville, so one's gone. Looking back a decade ago, average sales price for single-family homes in Janesville was $99,241. Today, we're at $211,589. In a decade, that's a 113% increase. Looking back at that time frame, there was the administration had the tax credit. If you were a first-time home buyer back in 2008, 9, 10, and 11, that was excellent. Our average sale price actually in our office that year in 2011 was $89,542. We had a 2-for-1 sale going on. Of those closings, 170 of them were short sales and foreclosures. Over the last decade, the real estate accelerator has definitely been down. What's fueling this hottest real estate market effort? Persistent shortage of inventory. The root of the boom is simply too few homes. A normal real estate market in Janesville will have between a 3 to 6 month inventory, probably somewhere between 2 and 500 residential units. Today we have less than a month. On average, the first 5 months of the year, homes were been on the market for 20 days. A decade ago, they were on the market for 103. Buyers don't even have time right now to catch a breath to make a decision on buying a home. Both agents and buyers are getting frustrated, writing multiple offers. I have agents in our office that have wrote 10, 15 offers with buyers and being unsuccessful. This shortage isn't going to go away anytime soon. We think we're going to be short of houses probably at least until 2023, 2024. As both Dave and Ryan mentioned earlier, buyers are moving to more cost-effective locations and buying bigger homes with more amenities. Homes with finished basements, home offices, pools. The buyer is actually looking to spend more time at home and putting a lot more value into the home. They're also moving to more cost-effective states. Texas and Florida, being a low-tax state, did see a little more acceleration in the boom. Also, Wisconsin being a low property value state, and tends to drive our force quite a bit. But companies and families are both finding it very cost-effective for people to work from home. As Dave mentioned earlier, being the professional in the building, the cost of building is driving this. Lumber prices have exploded. Shortage of developed land. I would bet we've probably developed more lots in the last 2 years than we have over the last 10. So we are working our way through it on the construction side. Labor force, as Dave has mentioned as well, it is tight in the trades. The folks that left the trades in the 2000s simply some of them have not come back, and they're not coming back. I think one of the easiest ways to help us get out of this shortage of housing is to build our way through it. The other one I found that's kind of interesting is the number of, there's more realtors out there in the marketplace than there's agents. In April, there was 1.61 million listings in the United States and 1.48 million realtors. Closer to home, right now we have 39 active listings in Janesville and 121 in Rock County and 256 agents. That's a lot of professional salespeople competing for a very low inventory. We have more agents competing for few sales, which makes the negotiations extremely tough. I mean, buyers are getting beat up left and right. They're paying over asking price significantly. We'll talk about that in a moment. Also, if you're a first-time home buyer or have friends or family members that are first-time home buyers trying to buy their first house, it is extremely tough out there. Low money down loans are hard because there's so much cash in the market. So let's talk about the sales process here. Historically, before 2014, you'd have an offer come in, in most cases somewhat under asking price, depending on the advice of the buyer or the buyer got from their agent or mom and dad saying, let's write a lowball offer. That's gone out the window. If sellers were lucky back then, maybe 1, 2, 3 offers would come in. If it's 2 or 3, if it's priced in a good location. And then the counter offers, multiple counter offers would take place. Now the new norm, the list price is just a suggestion. We have no idea where it's going. Owners are allowing showing periods somewhere between 4 and 7 days. At the end of the showing period, they're going to review the offers and make a decision based upon cleanliness of the offer and price. Counter offers, multiple counter offers are somewhat uncommon now. The owners are picking the highest and the best. The contingencies are kind of going away as well. Home inspection and testing contingencies are much less common. There's also so much more cash in this market right now. It's unbelievable how much cash is out there. Homes are selling somewhere in our market right now, $5,000 to $35,000 over asking price, and that isn't going down. It's going to continue for quite a while. This is not just the single-family homes. It's the multifamily and condos follow suit. There's only 11 condos on the market in Rock County, and 8 of them being in Janesville. Multifamily, there's 18 units in Rock County, and 7 of them being in Janesville. Multifamily units are totally crazy for our investors at RK Smith. They're constantly buying, and a lot of them are cash. Just it's obscene. In most cases, same following suit, probably somewhere between $5,000 and $25,000 over asking. So the sales side is one side of the coin. Now we slip over to the rental side. So at RK Smith, we manage somewhere between 1,150 and 1,200 units between Janesville, Edgerton, and Milton. If you go to our website today, you'd find 9 units available. Absolutely nuts how low our inventory is. This has been this way for months. We have a waiting list of people trying to find properties here in Janesville. The only reason why that number is 9 on our website, we posted on Monday our May turnovers. So early in the month, we have a few more. By the end of the month, there'll be nothing. We have pre-approved tenants waiting for a property to become available for them. Rents are steadily increasing, and the rental market is as competitive, if not more competitive, than single-family sales. And as Ryan mentioned, the other fuel to our fire is the low interest rates below 3% on a 30-year mortgage is simply incredible. And even though the pricing in Janesville, Wisconsin is increasing so fast, with the low interest rates, it's helped keep the housing affordable, even as the average price increased. So looking forward, as everyone else, as talked so far, I think rates are going to stay low, but at some point they're going to have to increase, I would assume. If inflation stays in check and unemployment stays low, there's not an end in sight to this. This will run for a while yet. What we need more existing market inventory. We need sellers to get off the fence and make a decision to buy. Problem is there's been a fundamental change in purchasing real estate. Back in the day, you go back pre-2015, a buyer would own a home and go out to purchase a new home, buy a home with a sale of home contingency. Not the case anymore. Buyers have to make a decision when they own on the house they're going to buy before they sell. Number one, the seller of the house they're going to buy is not going to accept a sale of home contingency. And number two, you got to know where you're going before you put your house on the market, or you're going to be homeless. It's going to sell that quick. Offers on those transactions too. When you bring your house to the market, you can dictate all the terms. You can dictate the closing date. You can dictate if they're doing inspections. It's absolutely incredible. The other thing is we need to add more workforce. We need more people in the trades working. Also, when we have those jobs, as people move into our community, it's just going to add more gas to the fire. I think one of the other things that we haven't even thought about yet is the 90 project. Once that project is done, my goodness, we could see the next boom coming. And the other thing too is, hats off to all of you. Look where we were a decade ago, 10 years ago. Selling houses 2 for 1, not knowing what end is up. All of us working together, have done a great job redeveloping Rock County and Janesville. There's going to be peaks and valleys in real estate. We're going to get to a point it's going to stop, drop, and it's going to go back up. But what people always have to remember with real estate is not it's not a race, it's a marathon. So if we keep moving forward, it's going to be a lot of good things in southern Wisconsin. Good place to live. Back to you, Mr. John.
All right. Thank you, Paul. And thanks for that little perspective there towards the end when you think where we were a decade ago. with
113% appreciation.
Yeah, and unemployment rates that were double digit, and I think there were people who had written us off as a community, and boy, did we flip that script over a decade. I think we should all be proud of the work that was done there. And part of that process of rebuilding our community was managed from the city's perspective by Gale Price, our economic development director. And Gale and I have had countless conversations about the local economy, what could make it and prosper and revitalize. Of course, downtown is part of that. But Gale, you have a unique perspective of sitting at the city looking at this problem of inventory, and especially when it comes to multifamily. But I'm going to let you choose your topics, but I hope you do touch on the multifamily market, because some of it's, of course, market rate. Some of it is supported in some fashion through tax credits or other government programs. Perhaps you could speak to that. Gale?
Well, thank you, John. I appreciate the opportunity to speak to the group today, and I am definitely going to touch on a lot of multifamily, but I also want to touch a little bit on a comparison on the single family between last year and this year. And Ryan, Dave, and Paul, that's great kind of opening for me to finish it out and button this up. So really appreciate those perspectives. So when we think about single and two family construction, 2020 was best year we've had since basically 2007. So we had 105 permits with an average reported construction cost of $202,000. When we fast forward that to this year, so far we are at 43 permits, and again, reflective of this cost of construction, an average of $278,000 for construction costs. So definitely a huge increase in that, all driven by that cost of lumber and also the lack of having tradespersons in the market to keep up with the demand. And so certainly, given the increases in the sale prices for the average home right now, I think we're going to see that continue to move up and stay steady. So definitely a good time to have an investment in real estate, especially if you want to downsize. To John's point, we really do want to talk a fair bit about multifamily, because when we did a housing summit in 2018, and we recognized that we had an issue. We had not had a multifamily building built in 13 years. And we knew that there was trends nationally to creating more demand, baby boomers wanting to downsize, young professionals choosing to not buy a home right off the bat. They wanted that quality multifamily living, and they wanted amenities with that, all things that we had not had developed in the community. And so as we moved forward, I led discussions with the city council about we needed to relook at this. So we made significant changes to our economic development policies, recognizing that we needed to kind of right the ship to make multifamily possible in the community, because people do not develop product philanthropically. They've got to make money on it. And so, which was a somewhat lengthy process of 6 months to get the council convinced that this is the right time to do it. And I can say there were some naysayers out there that didn't think that that was the right place to be. But when we think about housing as it relates to workforce, as it relates to businesses in the community securing the right labor, if we don't have that housing available, we're going to lose out. And I think we really were. So we got to the point 2 years ago where we started actually entering into development agreements and getting some development going on the multifamily side. So over the last, basically since last summer to let's call it the end of this summer, we've got a total of 316 units that will be coming online on larger scale projects. Now we have some upper story residentials here and there that are a little smaller scale. But when we think about the bigger projects, 316 units. Of those, 92 are workforce. That's the River Flats project downtown. But, that is a fair amount of units over that period of time, especially when you compare it to the previous 13 years. I can tell this group that every one of these units that have come online have been absorbed into the market just basically immediately. When we look at pro formas, they're a conservative projection of what the lease up looks like. And the anticipation was 90 days or 9 months. We actually lease up all of our new product within 60 days. And when we started this process, people never believed that we would be absorbing units that fast. And we are. And, what are some of those factors? Well, obviously, our unemployment rate and the fact that we have all kinds of jobs here. So our unemployment rate was at 4.9% in March. Nationally, it's at 6.2%. You see the help wanted signs all around town. There's obviously jobs to be had in Janesville and Rock County, and it is a place to relocate to for employment. To some of the other comments, we are actually seeing people move out of Chicago and come to Janesville and say, I want that quality of living. I don't want to be stuck in my apartment in the loop in another pandemic. I want to be able to walk around the block and not have to wear a face mask. And it's really helping to drive backfill of some of the units. Some of our apartment projects are actually marketing to people in Madison. It's hard to believe, but the civil unrest in Madison last year is driving people to Janesville for a different quality of life. And so as we, continue to capitalize on that, I guess another point is that we missed out on people that were locating here for jobs. They went to Beloit because they had apartment units available, and now that we've got units coming onto the market, they're coming back. So when we start looking forward here, we have the Glade. That's the Hovde project on the east side. They've got their third building under construction. It's going to be done at the end of the summer. They're already pre-leasing units, so if you know anyone that's interested in the Glade, they better give them a call. But that's going to be 48 units, and that's a little bit it's a tweaking of the unit types because they're focusing on what was getting absorbed and what had more interest. Now, they actually have 2 more buildings planned of 57 each, and we had been discussing moving those forward a whole 2 years ahead of schedule, but this continued increase in the cost of construction, they're reevaluating that and what that timing looks like. But, as we continue to see the demand, they may choose to go ahead and move forward with those here in the near term. And then downtown, we have the Monterey project that's going to be starting in earnest. That'll be 52 units. And we're very excited about that prospect because we do need high-end apartments in the downtown, and great to see that building get redeveloped. So when we look forward, we have a number of conversations going on right now, which, to me is pretty amazing. Many developers that are hearing about our story in Janesville are contacting us. They're talking to landowners. We have no less than 500 units under discussion right now in various locations within the community. Some of the challenges with that, and again, cost of construction, what does that look like? We had hoped that increases in the rental rates would help us align more with the cost of construction, but these increases in lumber and labor costs are eating that up. So these projects probably will not start until next year. Hopefully we'll have a better clarity as to what that looks like. But most of these projects take a year to develop and then come onto the market. So we're going to continue to have pressures on the multifamily market because we don't have that steady stream of units coming available. The optimum time to bring units available is in the spring and early summer. So I think we're going to continue to see that pressure. Our hope is that interest rates remain low. Some of the interest rates that we've seen on these multifamily projects has been incredibly low, which has been able to help them still move forward in light of some of these cost increases. And, we really think that, that interest rate, the continued demand is going to keep us in the driver's seat as we move forward. And it could be very much like Paul said, we won't have enough units really in the community until 2023 or 24, based on kind of the timing and how we can bring all these things to market. So very exciting time. It's going to help drive more population in the community. That's always good too. And just we'll see what the future holds as we move forward here.
Yeah, there's vitality in all nooks and corners of the community, isn't there? Yeah, it's a great time for the community. I guess the problems are the kinds of problems you want. I have a question from a caller, and it's not necessarily directed at anybody in particular, but I think I'm going to throw it to Ryan at least first. And it's kind of an interesting thought. We've been down this path with a superheated housing market in the recent past, and it ended in a disaster for the country and for the community. How confident are you that circumstances and protocols are different to prevent that kind of crash this time around?
Yeah, it's a great question, and it's certainly not one that we kind of ignore, right? And something that we want to make sure we take a temperature check on. One of the leading indicators for two leading indicators for the 2007 crash was the amount of investor purchases of homes, right? How many people were buying these 4, 5, 6 homes, all under the same income, all in the same stated income. So what we're calling that is investor purchases. And then the second piece is the products themselves. So I can tell you today we do not allow any of those products. We are much more stringent as a mortgage industry on the products we allow, especially since most of the loans are sold to Fannie and Freddie. They have really gotten great at putting the products in place. And then I would even say that banks like ourselves provide overlays to their guidelines, and they're called internal overlays. And so there is a extreme kind of risk-adverse policies in place to make sure that we are doing our part to kind of protect the housing market and protect the consumer alike. That's also a careful balance in making sure that we also approve qualified borrowers. So that's an important component, but certainly feel that we're in a very healthy environment, and the underlying trends are not the same, right? It's not the issues we're seeing today are first-time home buyers that are struggling, which I think one of the presenters mentioned. The first-time home buyers are struggling to buy their first home, which is causing this demand, and it is not somebody that's artificially inflating the environment of buying 5 homes and taking inventory off the market. So that's really, really important to note. And then really as I look at across at least our bank and probably the kind of again macro vision of the industry, it's very healthy. It's a healthy mix of refis and purchases. We are not seeing this inverse relationship between credit policy and products, and the mortgage-backed securities issues of 2007 have dissipated. There's a huge stringent guidelines on secondary market purchasing, corresponding lending, all of the kind of the variables at play that really led to this disaster, the Great Recession, no longer in the environment, and I'll use the phrase ecosystem anymore. And so I just feel like we're in such a healthier environment. And I do think that it's a compliment to the policies that are in place, and will continue to be in place because it protects both the lenders and the consumers, which is important.
That's very good. Just to follow up, the whole public policy question, things related to real estate are often a function of public policy. Now, that can be as simple as interest rate. But, Dave, I'm going to pass it to you. Are there public policy ideas that you've contemplated that could perhaps help when it comes to expanding the inventory of new homes, for example? I think of developing lots, for example, is something that's talked about often. And in some communities, of course, let's just say there's more incentives on the table for new home lot development than there are here. Could you speak to that issue?
Yeah, I mean, I think first thing I'd say is Paul said it best, and he said we need to build our way out of this situation, right, or build our way back to stability, maybe, right? And yes, there are things that could be done, at least in our community. We work with many builders in the Midwest, and so we have exposure to other communities and what is going on there. And I think what my recommendation to Gale and team at the city is, I think those are things that we should explore, right? I think we should explore public-private partnerships. I know that at one time those were done in various ways, and maybe they didn't work out, and that's okay, right? And I think there's maybe better ways to go about it, but I think we should be exploring those alternatives, because I think I'll give you one opportunity, right? I think I've said this to a number of folks in the past, is that, we have a declining enrollment challenge in Janesville, right, with our school district. And so we need to get more people into the school district, right? And when you look at where most of the development is, it is not in the school district. And that's a challenge that, we all face as a community. And, I can tell you that we'd love to be part of that solution if we could. I think Paul would like to be part of that solution. I think Gale would like to be part of that solution. And so I think, John, it's one of those things that we do need to sit down and explore because there's definitely an opportunity there.
Gale, do you want to toss in any thoughts as it relates to public policy, since obviously that's your bailiwick?
Yeah, so we did have a long-standing partnership in the development side, as the city had been the primary financer for residential subdivision development, and we did take a beating during the Great Recession, and all the taxpayers had to cover that eventually, but. We've had some exploration or discussion about that in the recent past. There's not been an appetite for that. But is there other areas that we can focus on that helps to facilitate that changes some of these development costs? As Dave mentioned, he works in a lot of different communities. I came from Champaign, Illinois. Our approaches were a lot different. Smaller lot sizes, narrower streets. Things that you could do to reduce those upfront development costs, and then that helps to create a better price point for the product when it does hit the market. Those are all things that we need to consider and be open to. From a city standpoint, higher density in a residential subdivision actually brings a higher return on investment for us in addition to the developers. So those are all things that certainly I'm an advocate for and open to in City Hall. Let's keep the community with City of Parks, and maybe we reduce some of those backyard sizes and have the kids go play in the park rather than in the backyard. So, I really think there's some opportunities there, and certainly from a city perspective, I'm open to furthering those discussions in partnership with our development community.
And I have to ask, are there ongoing conversations between the development community and the city on these issues?
Yeah, there's not been in the recent, I think the COVID pandemic kind of shut things down in discussion. And right now we're all reacting to the initial or in the current market demand. So it's a matter of making it a priority and saying, hey, let's sit down and talk about this. And maybe things slow down in December and we can start really having those in earnest.
Right. Yeah, Dave talked about the fact that people want to live here, and if there aren't options, whether it's rental or purchase, we lose out. And of course, we hear from the business community more generally every day that the workforce shortage is a critical issue, and finding the reasons why people are not moving here there's several reasons, but one of them is housing, and so there's a lot of reasons why we need to wrap our heads around this. Paul, you've been at this for 20-some years on the rental and the single-family side. Do you have any threads or suggestions that we should all take away and continue talking about to solve this problem?
The biggest thing is getting more homes to the market. Dave and the other builders in the community, I mean, we just got to keep on pumping homes out. I think we need to keep the spec homes are going to be a big key. Taking a little bit of risk and putting those foundations in the ground to give these people an opportunity or a place to move is very important. When we did the summit with Gale, you said 2018, it was a few years back. We talked. We had 500 to 700 units built for rental properties in this community. I think we might have shot it a little short. Because the workforce needs housing, and when 90 comes through, something's going to happen to the GM land, and we're going to be short to house these people that are going to be coming this direction. If you take a little look at history, look at the 94 between Chicago and Milwaukee. What happened when that developed? It blew up. So, and we're in a pretty nice location. You got Milwaukee, Madison, Chicago, Minneapolis. We're right in the middle of it. So housing in Janesville will be pretty stable, I would say, for quite a while.
Well, Ryan, the last question that's come in, and I'm going to throw it to you, is put your prognosticator's hat on as it relates to interest rates. And I think most of us think those rates are going to go up in due time, given the inflationary pressures not only of wage rates and salaries, labor costs, but also, your basic oil prices and all sorts of supply chain costs are going up. What impact is that going to have whenever it happens? How fast is that going to cool the jets on this housing market?
Yeah, it's a great question, one that we have, daily with our economists and also just my team. And, I think to answer, will it turn the throttle off in terms of refi? No, because we're still seeing, the 6%ers come in and refi at 3%, which, again, where have they been is the question. It's not the world we're living in of if a rate goes and moves 25 bips or moves 30 bips, will that have a material impact on refi? I think we'll start to see a true shift in behavior and a true shift in capacity freeing up will be when we get over that 4% mark. I think my feelings are shared with many in the industry, and you can probably see that on Housing Wire and other publications of the 4% historically is an indicating rate benchmark to say once it gets there, a lot of ripple effects tend to happen. But when we hover in the 3% space, it really does. It does not change consumer demand or consumer behavior that much. Especially from a purchasing perspective. So 4% seems to be the one where you start to have this waterfall effect and start to see kind of immediate, to kind of answer the question, an immediate impact. We're talking immediate being probably a month, and then you start to really hear the news of some opportunities freeing up, homes freeing up, inventory becoming available, and really capacity at the mortgage lender perspective as well. I think that's a big component I probably haven't talked about enough is, capacity is a big factor. Most banks are operating in non-banks, non-lenders like a guaranteed rate or Loan Depot, and not to speak for them, but I can say that most are operating at kind of the red in terms of capacity, and so the higher rates also help with that, which then allows for quicker turn times and more deals to get through the cycle. So 4% tends to be the benchmark, just to answer the question. Then about a month after that is when you'll really start to see kind of notable news in the industry around some of the impacts on the inventory and ability to buy.
Terrific information. Thanks for that perspective, Ryan. I'm sure a lot of our callers will hang on to that 4% watermark and remember that comment. We are out of time, and one more thank you to BMO Harris Bank for sponsoring this series of calls, and of course, thank you to all of our panelists who joined us today. Dave Hiller, CEO of Amwood Homes, Ryan Walsh, head of U.S. mortgage sales at BMO Harris, Paul Schieldt, Coldwell banker, and R.K. Smith, and of course Gale Price, the Economic Development Director for the City of Janesville. I hope you all have a great day, and I again thank you for joining us for this conference call. Stay tuned. We'll plan the next one, and you'll hear about it soon. Have a good day.